I'm Michael Fox, and this is the Prospector News Podcast. And joining me is longtime friend and constant contributor, Chris Temple of the National Investor. Welcome, Chris.
Hey, thanks, Mike. How are you?
I'm doing pretty good, but looks like Chairman Powell of the Fed kind of tossed a late summer turd into the punch bowl.
Well, he did. There was one big surprise that came out today that nobody really had contemplated. Nobody expected, first of all, the Fed was going to raise rates today. They already had made pretty clear, and the chatter was almost unanimous that they're going to skip another meeting. As Powell said today, we've got the luxury, since we've done most of our work now, to sit and watch and wait. And of course, there's a lot of one-off things going on right now too that they don't really want to have to react to, good or bad. So that wasn't a surprise. The two surprises, the smaller one first, at the last meeting when they did their summary of economic projections in the dot plot, which I think is every other meeting, that when they actually put out the so-called dot plot, 12 out of the 19 Fed heads still saw one more rate hike over the balance of 2023. It was almost universally believed that, given the somewhat weaker economic numbers and whatnot, that number was going to change, but it did not. So the majority of Fed officials still see one more rate hike, whether it's in November or December. The bigger shock was when they took rate cuts off the table for 2024. Nobody had contemplated that. I didn't even think they were necessarily going to do that. But before today, again, if you expect one more hike in 2023, the view had been until today that there would be a total of 100 basis points of cuts in 2024 when the Fed starts cutting, theoretically mid-year time frame or so. They took two of those off the table. So now, instead of 2024 ending with a federal funds rate of 4.625%, if you look at the mid-range between 4.5 and 4.75, now you're looking at the federal funds rate ending 2024 still above 5%. And nobody was figuring that was going to come out. Furthermore, the Fed upgraded belatedly their assessment of the economy, how strong employment is, surprisingly robust and resilient is how we characterize consumer spending. Real estate prices have rebounded back to their old highs, even though activity is still slack for a number of reasons. But all of those things together, and I was just penning some last minute thoughts I'm putting in a new issue to our members tonight. Not only does all of this mean potentially that there's one more rate hike for 2023, but they may have to keep going into next year, whether it's in the form of taking those last two hikes or cuts rather for the next year off the table, raising the rate again further, because the one notable thing that they did not belatedly react to, Mike, was they did not change their inflation projections, which still show at a slower rate now, inflation fluttering down until finally in 2026, it's near their supposed 2% target. If we continue to see these increases in costs for energy and food, services continue to go up at faster than the headline rate when you take many of them. And over the next couple of 3 months, the inflation numbers are making them look about as stupid in rebounding as their previous numbers on the economy and unemployment did. We still may see rate hikes in 2024 unless things have imploded, between now and then, or weakened sufficiently that takes some of the steam out of this. So, higher for longer was not only going to be the mantra coming out of this, but you can at least add the word much in front of the longer. So they're going to keep rates high for much longer than had been expected. And Powell suggested even until 2026, he wants to see real interest rates stay positive. And that, of course, means the level of interest rates is above their core inflation measures. You've got that with some of the yield curve right now. He wants to see it with all of the yield curve, and he wants to see it for a hell of a long time. And so yet again today, and I would argue his most emphatic way still, he has made clear that they are not going to be changing their monetary policy at the first few tentative signs of a slowing economy. They want a slowing economy. They want the economy growing below trend. They want unemployment to tick up. And he doesn't always come out and say these things in exactly those terms, but you boil it all down, and that's what they want. So, you know, the key question now is, how seriously do the markets take him? They definitely took him seriously as the question and answer session went on today, and they realized, holy cow, he's not going to be in a hurry to cut. Holy cow, we might still have one more rate hike.
Yeah, the market definitely seemed, you could see when the press conference had, because the charts just like dive off the cliff. The reality is, I think they're wrong with the inflation. The inflation numbers are already starting to tick up. The increase in energy costs has not been baked into that. And, you know, using the the current UAW strike as a measure, there's still labor unrest trying to push wage rates up, which is also inflationary, and that it pushes costs up. And I don't see this inflation battle ending next year either.
Well, it won't. And I think that the biggest danger right now for the markets broadly, especially the most overvalued segment still of the equity markets, being a lot of corporate debt that's out there that has taken very little notice of the fact that we're going to have this higher for longer interest rate environment. The NASDAQ, the tech stocks, the so-called growth stocks with these nosebleed PE ratios for those that even have an E, any earnings at all of those things have been priced again in 2023 in fits and starts, based on the notion that we are going to sooner rather than later go back to that 2% inflation target. It's going to allow the Fed to relent, et cetera. And you don't see yet much evidence in the pricing of any assets in the market. That's a general statement. There are, of course, a few exceptions. But generally speaking, you do not see the recognition that we're in a new world, that inflation is going to stay chronically high. We're not going to bottom at 2%, no matter what happens, most likely, barring a complete debacle and implosion of the global economy. And then it'll only be down temporarily. But barring that, you're not going to see inflation back to 2%. If we're lucky, it bottoms out at 3.5 to 4, but it's going to stay there and maybe pop up every now and then. Accordingly, and this is what Powell is driving home, even if he doesn't want to fully admit the inflation part of it, yes, interest rates are going to stay high for quite some time to come. And these things still are given very little credence by markets, who have got this idea in their head that we still have some binary outcome ahead, the next phase of which, after we've had this aberrant high inflation and the Fed jack up interest rates to fix it, that now the only logical conclusion is that inflation is going to come right back down and be tamed, and the Fed can become friend again rather than foe. And nobody is contemplating, or very few are contemplating, a third option, and that is that both of those situations are going to be wrong, and we are going to have this chronic great stagflation for as far ahead as you want to look.
Well, I'm like, even in the data points now, I'm starting to see the beginning of that stagflation coming. Like we've talked about the inflation rate going to start to tick up because of energy and labor costs factoring into it. What I didn't mention was the unemployment rate. The unemployment numbers came out a couple of weeks ago, and the unemployment rate quietly ticked up a couple of tenths of a percent. And I think we're now starting to see the unemployment numbers start to reflect those layoffs that occurred through February, March, and April, because a lot of those people got paid out for 6 months before they had to apply for employment benefits from the government. And now they're starting to apply, and those numbers are starting to get reflected. I think we're headed into a position of that stagflation where we're going to see, higher than we would like inflation and higher than we would like unemployment. And I see at some point next year, the Fed's going to be faced with a Sophie's choice. Do they fight inflation, or do they fight the recession?
Well, I'll tell you what, and this, I think, Mike, is some of the reason why the market declined into the end of the day today as Powell was talking, because when he was hit with exactly that question, and I think it was NPR's longtime chief economic reporter, Nancy Marshall-Gisner, who I think she was the one who asked this point blank, he made absolutely no mistake of his idea that if he has to choose between a recession and taming inflation, he's choosing recession. 3 times that I counted during that meeting, and one of those times being in part of his answer to her question, he made very plain. I'm even pulling this quote up, as we're talking. The worst thing we can do is fail to restore price stability. He said that 3 times by my count, and once again in answer to her question. So he's already decided that the worst of both choices is not taming inflation. He's got this phobia, which is self-inflicted to a great extent, because this problem started with him creating all this inflation in the first place. But he's got this phobia over being like Arthur Burns in the 1970s, who was Nixon's disastrous appointee to the Fed back in those days. And of course, that was notable in that it was right after we went off the gold standard. So it was especially bad, and especially bad since the U.S. was the only major, developed economy at that time that was debauching its currency. Now everybody else has joined in, and they're doing it as bad or worse than we do. But he doesn't want to do what Arthur Burns did and start raising rates and then slow down and relax because he's worried about the recession. And in those days, also worried about the Arab oil embargo, pushing oil up to a record high at that time, only to have to later go back and redouble efforts to fight inflation when it became evident that he never should have stopped in the first place. And so he has repeated that refrain over and over again. And Fed watchers who were, sympathetic to that argument have repeated it over and over again. And it's why he repeated today that his choice, if he has to make one, you put a gun to his head, he'll take a recession. And that underscores further the idea that they are damn serious about higher for longer. And bit by bit, I think more people in the markets are going to wake up. They've started waking up more when you look at the Treasury yield curve, because in just the last couple of days, I think they softened late in the afternoon today, but you've had new cycle high for interest rates. I listened to a guy the other day who swore up and down that the technical chart of the 10-year yield that had an outside reversal day a week or 10 days ago, whenever it was, meant that we've seen the high for the 10-year yield. I'm sorry, but the 10-year yield, unless we had a major hit to the economy before that, the 10-year yield, which has been nudging just above its high from 2007, and that's at around 435. There's going to be a 5 handle on the 10-year yield before this is all done, probably by the beginning of next year.
Yeah, I wouldn't disagree with that. It's just, we keep seeing this. He keeps talking about inflation. As we go further and further along in this mess, I see it less likely for that soft landing that, he seems to be down on his knees praying for.
Well, there was a couple of entertaining exchanges today on the whole soft landing thing. He I think got some people a little confused. I don't think he did it intentionally. When someone asked him a question, is a soft landing still your base case? And he said no. And that got some people curious. He had to clarify that later on. It said it's not like we don't want one. That's what we're trying to achieve, is a soft landing. But he was trying to cover all the bases, as Fed heads usually do, and we just don't know. We don't know if we're going to go too far and cause a recession. Things, and he, was, I think, forthright and a little humble in admitting when somebody called him on how lousy a track record the Fed has in the first place, it divining the future. He says, "Well, of course we have a lousy record. It's a humbling thing." But the whole soft landing thing, to me, Mike, it's just like so many things today. It's so hard to judge it in terms of what past business cycles used to look like. Because, as I think you and I have talked about more than once here and elsewhere, we don't have a typical business cycle anymore. We haven't had one, you can argue, at least for the last 20 years. And you can even go back potentially to the beginning of the 1980s when Paul Volcker was the one who introduced credit cycles, which have ended up supplanting the traditional business cycle. Credit cycles drive economic activity by the expansion of credit and a monetary base. And then you reverse that credit cycle and the economy with it when you tighten policy, et cetera. It used to be that the Fed, with its monetary policy, was simply a governor of the organic economy. Now it's the originator, since credit and ever increasing levels of credit and monetary growth have become the initial driver of economic activity. So that's where we are. And understanding that, it's hard to define what the hell a soft landing is, I think, in some ways anyway. And not to mention the fact as well that you've got a lot of one-off things going on in the world. And that today I heard encouraging things out of Powell's mouth, and I heard damn scary things out of Powell's mouth as far as how much damage he might do in the end. The rest of the world is not in very good shape. Europe is in recession. Japan has really never emerged meaningfully from one for anything but a short period of time. And yet they have a policy meeting this week, which could mean every bit as much to the global markets as what we think the Fed does, because they're taking one baby step at a time and hope no one makes too big a deal out of it toward their own regimen of normalizing markets. And we're in a lot of trouble. And I've talked about this for several months now. We're in a lot of trouble if Japan doesn't become the inflator, or doesn't remain the inflator of last resort in global markets. So I don't know. I think the situation that we're in right now is one, as I've said before as well, that's courtesy of having a flawed, mathematically untenable, and some would argue unconstitutional and immoral monetary system to begin with, where increasingly there are no right answers. There's only degrees of how much they're going to ruin things beyond what they've already done. And that's where we're at. So, with all of those bad Hobson's choices that Powell has, he did, pardon my rambling answer, he did make very clear that he is going to take a recession before he's going to give up on the inflation fight.
Yeah, the more I see as we get down this particular road, I end up in two different places. I end up back in my economics class at the university and realizing that if I proposed what the Fed is doing today, they would have failed my ass and thrown me out and said, "No, son, economics is not for you."
Yeah.
That's the first thing. And then remember the words of my father. He always said, you know what? If you don't know what you're doing, don't try and fix it. You'll just make it worse.
Yeah. Yeah. My dad had a similar saying: when you don't know what you're doing, don't do it. So very, very appropriate. So look, we've got more data coming out ahead of the next Fed meetings and whatnot, but here's where I think things are going to get interesting and I already, in a couple of ways. First of all, and this is what we need to watch to try and figure out what we want to do where gold is concerned, where, as you may have seen last week, I pulled the plug on a short position that I had advocated for a while. It was a mildly profitable one, but it was based on my belief that gold was still in some near-term trouble. I'm less of a mind than it is right now, despite everything I just said of the Fed staying tough, because I think that as time goes on, we're going to see gold react a bit more positively to worries about higher for longer rates, because let's keep in the back of our minds that what the Fed means probably by higher for longer is still going to have them behind. And we will see these recent moves on some yields back in the positive real interest rate territory start to go negative again at a point when the economy is weakening and the Fed won't dare push in too much more. They'll keep rates up, but they won't raise them more. So anyway, we want to see what happens with that. I think the inflation numbers are going to go up. The Fed's going to have to react to it. It's going to be more difficult for them to react to that, though they may try if they think they can get away with it. And I also think, Mike, that we need to see the speed with which equity markets primarily catch up to bond pricing, which has finally started in a somewhat bigger way, probably not enough yet, but in a somewhat bigger way, to reflect the world and the picture that Powell painted for us yet again today. The bond market still doesn't get it completely, but it gets it more than the stock market does, because we should be across the board, and not every sector, of course, because there's some like uranium and like oil and like some others that will do better because of their own individual dynamics. But when you look at the reality in front of us, you look at what the Fed just said, the NASDAQ should probably right now be 20 to 30% lower, and the S&P 500 should be 10 to 20% lower. And do they get there in a grinding way between now and next year sometime, or do they get there in a precipitous way? We'll see. And again, I'm watching the Bank of Japan this week too, because there are a lot of reasons why the latest bump up in interest rates for Japanese government bonds to their highest in a very long time could have reversed, and it didn't. And if we see in the wake of their meeting this week a further tick up in yields, that's only going to increase the odds that we have more financial market mayhem for even U.S. assets, which, relatively speaking, are still the best in the world among developed economies.
Yeah, well, as Rick Rule says, it's still the prettiest horse in the slaughterhouse.
Right.
Well, interesting times. I think we're definitely at a fulcrum point here where there's a number of factors that can create some market mayhem. So I think everyone needs to pay attention and be flexible enough to react quickly.
Well, very much, and I have to say too, Mike, that one of the things that U.S. markets still have going for them is they're still the most liquid and the deepest markets in the world, relatively speaking, though I think there's a lot that is being hidden and that hasn't hit the fan yet. But again, in relative terms, our banking system and financial structure remain better than Europe, certainly better than China. Japan in recent months is a renewed question mark. And as I've said many a time in the recent past, it's light years beyond any imagined so-called BRICS currency, which we're not going to see maybe even in our lifetimes. There's a lot of stuff that is going on with those nations, But there again, as a financial block or potential financial center, they are utterly no rival to the dollar and dollar assets either, at least at this point in time. You don't have to like that, but that's the fact.
Yeah, the dollar demisers out there, I think, uh, you know, we were supposed to have a new currency at least a half a dozen times in the last 2 years, and it still hasn't happened. So,
Well, the latest come on from one of these shysters that was talking about Biden bucks till you got sick of it for months and months and months. Now the new angle, getting pretty much to the same point as his insistence that Saudi Arabia is about to declare financial war on America.
oh, well, let's bite the hand that feeds us.
I mean, look, Saudi Arabia does want to be a new member of the BRICS and all this stuff, but as usual with this particular guy, he takes maybe a grain of truth and spins it into bullshit.
Yeah, well, it's important to have a skill, right?
He's good at that.
Yeah, no doubt. But and when it comes to Saudi Arabia, truthfully, they're just playing both sides.
Of course they are. And they made very clear they're playing both sides. On top of, right, no sooner did they join up with the BRICS, then they followed Biden recently into some alleged counter to China's Belt and Road Initiative that Biden is trying to cobble together for the Middle East and Africa. So, look, the U.S. is still competing with China and with others. Neither one of them has got the moral authority to do much of anything or the moral right, but they're trying to create and keep all the influence that they can. And I don't blame Saudi Arabia for 2 seconds playing both sides of the street. Because in the end, even though they're playing China against the U.S., they're still looking out for number one, and bully for them.
Yeah, well, that's the role of their government, is to look after their people.
Yeah.
And I laugh about the Biden bucks just simply because I can't see anybody in America wanting to spend currency that has Joe Biden's name on it.
The sad thing is, and of course, this guy used Biden bucks just as his catchy little phrase. That wouldn't necessarily be called that if we had a China-like social currency, which is a non-starter in this country right now, as I've explained, for a handful of different reasons. But look, there's no question that the whole world is in a lot of trouble, including the U.S. When I discuss these things with people about the U.S. dollar, its role as a reserve currency and so forth. And, you've heard me say this, you in your current magazine, you've got an article for me about this. But, it's just in relative terms, we're better off than most others are. Is it always going to be that way? No. Will the U.S. always be king of the hill financially? No. We've already lost a fair bit of economic clout simply by some of these BRICS and BRICS wannabes in other countries just doing their day-to-day transactions in their local currencies. That's already put a major dent in America's global hegemony, as it should. As those people look to get out from under Uncle Sam's thumb. So I don't say the things I do because I'm a fan of the U.S. or the U.S. dollar. And in fact, folks that don't like what I'm saying right now and believe all the Biden bucks and gold BRICS-backed currencies and all the other malarkey out there, be careful what you wish for, because when the time comes, and it will, that the U.S. has sufficiently lost its reserve status. And you got to remember, there's a big, big, big difference between a reserve currency and a currency that's used just for day-to-day transactions. 2 very separate subjects. But when that day comes, Americans are going to see their living standards plunge, because up until now, we've been able to run up $33 trillion in acknowledged federal debt and counting, besides everything else, and have our way over much of the world because we could compel the majority of the world and the majority of the transactions of the world to be done in our currency. So friend or foe, has been basically compelled to underwrite everything that this country does. When that goes away, the world is going to be a much safer place, because no longer will the U.S. be able to do that. We will have to directly inflate these costs instead of have some of that inflation borne by external buyers of our debt. And it will really come home to Americans. You didn't know you're getting a sermon, did you? It will
Oh no,
really
that's quite all right. You're
home.
absolutely not wrong. That's the
It,
reality. I'm just
it will
hoping it
really,
happens after I've left this
it'll really hit
particular
home to
planet.
Americans. I mean, think of this. And this is one of the reasons why my interest in sports of almost all kinds has just imploded in my, advancing years. Who would have ever thought? And I didn't see this as a kid growing up, even at the Super Bowl. But now, before so many sporting events, you got flyovers of fighter jets and the military is there and stuff. This is bread and circuses shit. Okay. Yeah. And why do we glorify conquering the world, killing people all over the world over real or imagined conflicts, virtually none of which threaten our own soil? And the big one that does threaten our soil, being an invasion through our southern border primarily, doesn't seem to matter. But all of these other phantom foreign things do. And we will no longer be able to, quote, pay for these things, we meaning the U.S., when the point comes that we don't have the world's reserve currency. And that's why I say the world will be a safer place, all else being equal, number one. But number two, Americans will see. You think that this return of double-digit inflation the last couple of years has been bad. Wait until you see what happens with Americans' own cost of living increases when we lose that reserve currency status. That won't be good.
No, it won't be that. It'll be a hyperinflationary.
And that will be the point. That will be the point where hyperinflation of the monetary base, which for so long now has gone elsewhere, does directly manifest itself in goods and services almost entirely. And the business you want to be in then is wheelbarrows. And be the first one to sell wheelbarrows for people's cash with your favorite pop star or your favorite sports team's logo or whatever. They'll sell like hotcakes.
Through that. So if people want to follow your musings on everything, how would they do so, Chris?
Well, if you still want to, after all of that, go to nationalinvestor.com. If you're not already on my mailing list, make sure you sign up. And the best social media venue to follow me on is Twitter/X. And that's at @ NatInvestor.
Well, you know what? The sermon was appropriate today after Powell's meeting, so I think people should appreciate that and follow your musings, because you're generally pretty bang on.
Well, I try, and I call them as I see them. Like a friend of mine who I was having a political disagreement with the other day because he thought I was favoring one particular presidential candidate too much. I'm an equal opportunity pisser offer. So I just call them as I see them, try and worry about truth and facts. And it's going to gore a lot of oxes of people who already are predisposed toward one political persuasion or one financial persuasion or whatever. But I think that's part of our problem. And it's really true, the old saying that it's easier to learn truth than it is to unlearn error. Whether you're an investor or just a citizen, we've been fed so much error that the truth does seem strange when it hits you.
Yeah, no doubt. They just refer to that as a glitch in the matrix now.
Yeah, that's right.
Okay, look forward to chatting again soon. Take care, Chris.
Absolutely. Take care.
The Prospector News podcast is for educational purposes only. The opinions expressed are those of the participants and are not to be taken as investment advice. Listeners need to do their own due diligence and seek advice of a licensed investment advisor.